Have you ever watched two people, right? They're executing the exact same trading strategies, same charts, same indicators, maybe even the same entry signals.
Yeah.
Yet one of them, they just compound their capital year after year consistently.
Yeah.
And the other one, just bleeding cash.
It's one of the most frustrating things to see. Baffling, really.
Totally baffling.
Yeah.
Why the huge difference in results when the method's identical?
Well, what's fascinating, and this is really the core of what we're diving into today, is that the answer, it lies almost entirely outside technical analysis, often outside the market itself.
Okay.
So we're digging into the essential psychological toolkit from Mark Douglas's groundbreaking classic, The Disciplined Trader,
Right.
Developing Winning Attitudes.
A foundational text.
Absolutely. And our mission really is to cut through all that noise, the analysis overload, and get straight to this profound realization. Successful trading is primarily about mental discipline, not predicting where the market's going next.
And Douglas's own story gives this so much weight, doesn't it?
Yeah.
He wasn't some academic just theorizing.
Not at all.
He was a trader.
Yeah.
Got absolutely humbled early on. Painful losses almost wiped him out.
Exactly. And that failure, that pain, it forced him to look inward. He realized, wait, my systems aren't the main problem here. I am, or rather, my thinking is.
Right.
And that led him to his core philosophy, which, it's pretty stark when you first hear it. Success in trading is roughly 80% psychology.
80%?
80. And only 20% methodology.
Wow. That's huge.
It's a staggering ratio. Seems almost unbelievable at first. But when you really understand the trading environment, it starts to make perfect sense.
Okay.
So the key thing we need you, the listener, to really internalize today is this. Those mental habits, the beliefs deeply ingrained in you that make you successful in everyday life.
Yeah.
They actually become your biggest obstacles when you face the market's completely unstructured, unpredictable reality.
Okay, let's really unpack that fundamental conflict then.
Right.
Because it feels counterintuitive, right? Why are the skills that serve us well out there, in the normal world, actually toxic in the trading arena?
Well, think about your normal life for a second. Your career, maybe your education, relationships. You are heavily, heavily rewarded for certainty.
For being right.
For being right, for avoiding mistakes. Outcomes are generally, somewhat predictable based on effort, and there are external rules.
Laws, company policies.
Exactly. Things that protect you from, utter chaos. You operate under the assumption that A leads to B, more or less.
And we need that structure. We rely on it.
We do. The market, though, it's the absolute opposite. It's a world of constant total uncertainty. Outcomes are never guaranteed. And there are truly limitless possibilities for both profit and loss.
Right. No safety net.
None provided by the market itself. Your mind just isn't naturally wired to handle that level of freedom, that ambiguity, without tipping into fear or, euphoria.
So when you bring that need for certainty into the market,
you basically doom yourself to failure. That friction, that clash between our structured minds and the unstructured market, it immediately sparks what Douglas identified as the 4 major psychological traps.
it's like our default settings just short circuit in that environment.
Pretty much. They are primal reactions, really. The first trap is the need to be right.
The ego trap.
Absolutely. You get so intellectually attached to your analysis, your prediction, where the price should go, that you just refuse to accept it when the trade is clearly, obviously failing.
Oh, I know this one. Holding on, moving your stop loss further away.
Adding to a loser.
Yep, adding to a loser. All because your ego just cannot stomach saying, I was wrong.
That's the behavior, exactly. You're hoping, praying the market will turn around and validate you instead of just cutting the loss quickly like you should.
And that comes straight from real life, where being wrong often means, embarrassment or worse.
Precisely. Penalties, humiliation, maybe career damage in the market. Refusing to admit you're wrong is just guarantees financial pain. Simple as that.
Okay, so that's one. Then you've got fear of loss. Equally damaging, but kind of the opposite reaction.
Exactly. It stops you from acting when you should. Fear of loss causes that hesitation on good, solid setups. You see the perfect entry, your rules are met, but the fear of losing money makes you freeze.
And you missed the trade.
You missed the trade. Or, arguably worse sometimes, it causes the early exit. You jump out of a winning trade the second it shows a tiny profit.
Making pennies.
Right, securing a tiny gain but leaving huge potential profits on the table because you were terrified the market would reverse and take back that small win.
It's that constant push-pull. I don't want to lose versus I don't want to miss out. FOMO versus FIFLE, fear of losing everything.
It really is. And the flip side of that fear coin? Greed.
Ah, yes.
This is what leads to the really reckless stuff. Over-leveraging, trying to make a month's profit in one trade.
Or chasing some hot tip.
Exactly. Abandoning your solid, tested strategy because someone whispered about a sure thing that promises massive instant returns. Greed is basically impatience combined with terrible risk management, usually excessive position sizing.
And then the inevitable result after a bad loss, the emotional spiral, revenge trading.
This one is maybe the most destructive of all. Revenge trading is just impulsive, irrational decision-making, driven purely by that desire to get back at the market.
Like the market's a person who wronged you.
Right, like you need to punish it for taking your money. A classic example is someone immediately doubling down on the very next setup, even if it's a mediocre one.
He's desperate to make the loss back now.
Yes, their ego demands immediate recovery, immediate validation. It's a total loss of control, and it never, ever works out long term.
So those are the big four.
Yeah. And what's really crucial to grasp here is that these aren't like character flaws. You're not a bad person for feeling these things. They are natural, predictable, human emotional reactions to this highly uncertain, unstructured environment. The solution isn't trying to eliminate emotion that's impossible.
You can't become a robot.
No.
Ugh.
The key is to recognize these emotions when they arise and neutralize their negative influence on your decisions. Awareness first.
Yeah, makes a lot more sense. Okay, so if our brains aren't naturally built for this environment, we need a kind of mental system overhaul. What's the roadmap Douglas gives us for actually rewiring our minds, for building that disciplined state?
He lays out 5 core principles. Think of them as the structural rules you impose on yourself, since the market provides none. The first one sounds almost philosophical, but it's absolutely non-negotiable. The market is always right.
Tell me more about that. Why is that the bedrock?
Because the market is just this. Impersonal, indifferent force. It literally does not care one bit about your opinions, your sophisticated analysis, how much you need this trade to work out.
It just is what it is.
It just is. It operates based on the collective actions of all participants. Resisting what the market is actually doing, arguing with the price action you see on the screen is, as Douglas puts it, a recipe for disaster.
So you have to accept reality.
Instantly. The disciplined trader accepts the market's action immediately and flows with it, adapts rather than fights. That acceptance is the first step away from all the emotional pain.
Okay. And that acceptance seems to lead right into the second principle, which is about giving up that search for certainty, the thing that seems to cause all the problems.
Exactly right. Principle 2, embrace uncertainty and probability. This is a fundamental shift in perspective. You have to accept deep down that you will never, ever know for sure what the market will do next.
Nobody does.
Nobody. Successful traders stop chasing that impossible certainty. They start thinking purely in terms of probabilities, like a casino operates.
Right. A casino knows it'll lose on some individual hands of blackjack,
Absolutely.
but its edge guarantees profit over thousands of hands.
Precisely. They understand their trading edge, their system's positive expectancy, only plays out reliably over a series of trades, not on any single trade.
That sounds freeing, actually.
It is profoundly freeing. It means you can accept any single loss as just a normal, expected, statistical part of doing business. It frees you from the emotional trauma of being wrong.
It's just a cost.
It's a cost of doing business, not a personal failure, not a reflection on your intelligence, just statistics playing out.
Okay, that's a big one. And the third principle, this one requires maybe the highest level of accountability, often the toughest pill to swallow. Take full responsibility.
Douglas is adamant about this. 100% ownership of your results. No excuses.
No blaming the breaker, the news, the algorithm.
None of it. If you blame external factors for your losses, you're essentially giving away your power to learn and improve. You are in control of exactly 3 things.
Which are?
Your entries, your exits, and your risk management, especially position sizing. That's it. When you fully accept this level of responsibility, it's incredibly empowering. Because you stop seeing mistakes as random outside events hitting you. You start seeing them as valuable data points, information you generated that you can analyze and use to get better.
But wait, if I accept full responsibility, how do I stop that from just turning into harsh self-blame after every loss, leading to, like, analysis paralysis?
Ah, good question. And that's where the structure of the next principle comes in. Responsibility doesn't mean self-flagellation. It means accountability to your plan.
Okay.
Since the market gives you zero external rules to protect you from your own emotional impulses, you have to build them yourself. That's principle 4. Create your own
Yeah,
structure.
you build your own guardrails against the internal chaos.
Perfectly put. This means having a meticulously defined trading plan. Crystal clear rules for entry signals, exit signals, both for profit and loss, and critically, position sizing rules. Discipline, then, becomes simply the act of following your rules.
Even when it feels wrong, when your gut screams otherwise.
Especially then. Your plan becomes your objective shield against the internal storm of fear and greed. It's your personal control mechanism.
And that leads right into the ultimate fear reduction tool. Principle 5. Define your risk before you enter a trade.
This is probably the single most practical step for achieving emotional detachment during a trade. You must always know your uncle point.
Your what?
Your uncle point. Your predetermined exit point if the trade goes against you, the exact price or condition where you get out, no questions asked. And you need to know this before you ever hit the buy or sell button.
Ah, okay. The stop-loss point, essentially.
Yes, but it's more than just placing the order. It's about mentally accepting that potential loss beforehand. Pre-acceptance.
So you're trading with capital you've already, in a way, written off emotionally for that specific trade.
Exactly. You've pre-accepted the maximum cost of this particular business experiment. Once that risk is defined and truly accepted in your mind, the fear component is drastically reduced, often eliminated, while you're in the trade.
Because the worst realistic outcome is already known and okay.
It's known, accepted, and manageable according to your plan. If the trade works, great. If it hits your stop, it's just statistics, part of the process. You move on to the next high probability setup without carrying psychological baggage.
That is.
Yeah.
Yeah, that's a really comprehensive roadmap for internal change.
Yeah.
But Douglas really stresses, doesn't he, that this isn't just theory you read about. It takes hard work, daily practice to actually cement these new beliefs.
Oh, absolutely. It requires rigorous, consistent effort.
So what are the key actionable steps he recommends? How do you actually build this mindset day to day?
He highlights 3 fundamental practices for that behavioral change. First, and maybe the most critical for long-term improvement, keep a detailed trading journal.
And we're not just talking about logging P&L figures here, are we?
Definitely not. The profit and loss, that's secondary, almost irrelevant for this purpose. This journal is primarily a behavior log, a psychological diary.
Okay, so what goes in it?
You have to analyze your emotional state during the trade, your decision-making process. Ask yourself, was I fearful when the price moved against me? Did I feel impatient and jump in too early? Did I follow my entry rules exactly, my exit rules, my position sizing rules?
So tracking feelings and agility.
Yes. Track things like your confidence level before entry, your frustration level if stopped out. Maybe give yourself an adherence score. Did I follow my plan 100%? You need to reflect on why you did what you did, not just the dollar outcome. That self-reflection is where the real growth occurs.
It's like auditing your own mental game, spotting those traps in real time.
Precisely. Second, he strongly suggests actively working on reprogramming your underlying beliefs using affirmations and visualization.
Yeah.
You need to consciously, deliberately flood your subconscious mind with the beliefs of a successful, disciplined trader. You're essentially trying to overwrite those old, toxic, real-world assumptions that don't serve you in the market.
Can you give an example of an effective affirmation? Because sometimes just saying, I am a successful trader feels a bit empty, maybe, if you're not seeing results yet.
That's a great point. Effective affirmations focus on process, not outcome. So instead of, I will make $10,000 this month, which you don't control, try something like, I consistently execute my trading plan flawlessly, or I accept every loss as a statistical necessity without negative emotional reaction.
Focusing on what you can control, your actions.
Exactly. And then the visualization piece is crucial too. You need to vividly imagine yourself executing trades perfectly according to your plan. See yourself clicking the exit button without hesitation when your stop is hit. Feel the calmness and confidence even when the market gets choppy.
You're mentally rehearsing the desired behavior.
You're training your brain for that moment of truth, building the neural pathways for disciplined action. And finally, for anyone just starting out on this psychological journey, the most practical advice.
What is it?
Start small. Really small. This is absolutely critical. You are fundamentally learning a new skill here. And that skill is mental discipline under financial pressure.
Right.
So practice these mental skills, following the plan, accepting losses, journaling with a negligible amount of capital, money you genuinely do not care about losing.
Focus on the process, not the P&L initially.
Precisely.
Yeah.
Do not increase your position size until you have demonstrated consistent confidence in following your mental rules. Master the psychology first. The profits will eventually become the natural byproduct of that mastery.
That makes sense. Practice the mindset before you raise the stakes.
Couldn't say it better. Now, if we kind of connect all this back to the bigger picture, this work by Douglas, it remains a timeless classic for a reason. It successfully shifts the entire focus of the trading endeavor.
How so?
It moves your effort away from the impossible task, which is trying to predict the market with certainty, and redirects it entirely toward the achievable goal. Mastering yourself.
Controlling your internal environment, since you can't control the external one.
Exactly. The key to consistency isn't a magic indicator. It's unwavering discipline, strict adherence to your process, and taking complete, total ownership of your actions and results. Your journey.
So, thinking about our listener, the learner, what does this all really mean for you? This knowledge, it isn't just interesting theory. It's basically your essential manual for building a resilient, winning mindset. One that can actually withstand the unstructured chaos of these high-stakes environments. You need to stop asking, what's the market going to do? And start asking, what am I going to do according to my plan, regardless of what the market does?
That's the shift.
All right, so here's a final thought for you to chew on. Since the market provides absolutely no structure to protect you, and we've established you must create your own, what is the single most important rule regarding risk management? Maybe it's position sizing, maybe it's your stop-loss strategy that you need to define clearly and unequivocally for your own trading journey starting today.
Good question to ponder.
Get that one rule down on paper. Commit to it. That might just be your most crucial first step toward building real consistency. Something to think about until our next deep dive.